Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips podcast series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and your host. In today's episode, we'll be discussing alternative investments. We'll explore why you might want to consider these investments, the different types available, their limitations, and the trends shaping this dynamic landscape. Alternative investments go beyond the traditional mix of cash, stocks, and bonds. They've become powerful tools that allow you to diversify your portfolio and make it even more resilient. Let's start by understanding the factors driving interest in these investments. Historically, stocks and bonds have had a negative correlation for the most of the time, meaning that when one goes up, the other goes down, which means diversification can really help to smooth the investment ride. However, in recent years, this relationship has turned positive. Now, nobody knows how long this is going to last, but typically periods of higher than normal inflation are characterized by a positive correlation between equities and bonds, reducing the diversification benefits of traditional assets. So where else can you invest to diversify? Well, options include hedge funds, cryptocurrencies, commodities, and private assets. So let's start with hedge funds. These funds pull money from qualified, accredited, or professional investors and invest in a range of assets. These can include both traditional and alternative investments. Hedge funds are actively managed and they use strategies to try to deliver outsized returns. But this also means that the cost associated with hedge funds is quite high, as they generally charge high management fees as well as a performance fee on top. Now, the strategies that hedge funds can use vary from fund to fund. One strategy that is really starting to gain favour these days is the quantitative approach. Here, they use AI to refine investment decisions and boost the performance of the portfolio. Next, let's talk about cryptocurrencies. Most of you are probably familiar with them, and chances are some of you already have some exposure as well. These are virtual currencies that use cryptography for security, and they operate on decentralized networks. You'll be familiar with names like Bitcoin and Ethereum. Investing in cryptos can give you substantial returns, but remember, these are highly volatile, vulnerable to hacking, and not regulated stringently. Let's now move to commodities. Now, when we think about commodities, many of us think immediately about gold, and rightly so. Gold has held on to its safe haven status and is a popular long-term hedge against inflation. But there is more to the commodity universe. Natural resources such as precious metals, oil, and natural gas are so-called hard commodities. Agricultural products such as wheat, coffee, and sugar are characterized as soft commodities, and then we have a relatively new category called environmental commodities, which includes things like emission allowances, renewable energy certificates, carbon offsets, and water rights. However, it's important to note that commodities can be extremely volatile, and therefore any exposure should be very small within the context of a diversified portfolio. Finally, parallel to public markets, there's a whole other universe called private capital markets. This is where private companies raise capital from investors, but without needing to list their securities on public exchanges. This includes private equity and private debt. Private equity lets you invest directly or via private equity funds in private companies in exchange for a percentage ownership of the company. Historically, these investments have led to decent returns, even in grim economic conditions. In fact, if we look at a 5 to 10 year time frame, such assets have outpaced every other asset class. A trade-off here is that you usually have to tie up your money for a long period of time, for instance 7 to 10 years. Private debt, on the other hand, involves lending to private companies that have limited access to other forms of capital. These offer better yields than traditional debt instruments because they're structured with floating interest rates, and they're also collateralized or backed by assets. You have multiple variants such as commingled private debt instruments, which are professionally managed funds, And you can also consider investing in private debt issued by business development companies and small business investment companies. Okay, so I hope you found that useful. We've come to the end of the episode, but I hope it's given you some idea of different assets you can add to your portfolio to help navigate through market volatility. Thank you for joining me. If you'd like to know more about alternatives, please go to the link in the podcast to access the full InvesTips report. Until next time, take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.